In this video, I'm going to explain about bid and ask and market orders, limit orders, buying the difference between buying on the ask, selling on the ask, and the bid and so forth. So this is my broker Lightspeed that I use, and so this is level 2. This is my time in sales. This is my order entry window. This is just a list. I have hot buttons here. I can buy on the ask, sell on the bid, stop at entry. I can close out my long positions 100%, 75, 50, 25, and then the same thing for closing out or covering long shorts. So if I'm short, which is if you're new and you don't know, if you can make money when stocks go down. So if I was here and I shorted, I would sell shares here. So my broker would credit my account for, let's say, 100 shares at $288.64. And then if I can hang on until down here and I buy back shares, then I get to keep the difference between $280.66 and $288. So $8, it'd be 800 and something dollars, so of profit. So that can be done, but so that's to close out different portions. Like once you reach a milestone, you want to take 3/4 profit or half profit or quarter, depending. Everyone has their own strategy, but I tend to like to take 3/4 and let a quarter ride. But so this is an options level 2 window. It's pretty impressive. I like this software a lot. Different order types, limit, stop, all that. I'll explain this stuff in a minute. Today was Friday. I didn't trust the market today because we have a 3-day weekend. So I chose to just play today. Just do 25 shares of this, or one little contract that was like a $2 contract, at 2 cents, and just try to take it, to 10 cents, which would be $10, just to practice, So yeah, I only made 41 bucks, but actually the truth is, minus commissions, I probably made about 15, but it wasn't a day I took seriously. So what we have is, if you look at the level 2 here, this is the bid. These are the buyers, okay? And then these are the sellers. And this is the ask. So if you want to get in with a market order, you can just click market buy, right? And the orders, if there's enough shares, if you wanted 1 share or 600, 1,000 shares, if there's enough shares on the ask price right here, the lowest ask price is which is the price that you'd want, then you're gonna get filled for $281.60. But if the market's moving fast, the price action's just climbing, just super fast, and you click market order, you might get slippage in your entry, and you might get some shares filled at 281.60 and some filled at 282.10 or whatever, for example. So generally, I like to do limit orders. Limit orders, you can either buy on the ask. Just my broker, puts it. I can put it on the bid or the ask, or I can go scroll up and down or whatever and set any price I want. So a limit order, you can do. Let's say we're trading here, and I'm like, okay, it bounced off here a couple times. I didn't see any of this yet. I'm like, okay, if it bounces off this price again, I will want to go long. So 285. So I type 285 and buy, when the price goes to 285, I'm gonna wow, I just almost bought 1,000 shares of well, that's good, I didn't. But anyways, so sorry that threw me off there, but so it's a good idea to do a limit order. You can strategize more with the limit order, and then also when you buy a limit order, and if you do it on, see, I have a direct access broker, so Lightspeed is, Interactive Brokers is, there are others like Centerpoint, TradeStation has direct access, but they say that, you know, if you are like, you know, there's certain people like I honestly don't need direct access brokerage. I mean, it helps, but it's you know, you get what you pay for. You know, it's expensive. Like the commissions, you know, come out to a lot. I've paid a few $1,000s in commissions this year alone so far, but there's ways to get it cheaper. So like my they charged me for if I bought 1,000 shares, I have to pay $4.50 to buy it, and $4.50 when I sell 1,000 shares. The cheapest I can get a transaction for is $1. That's like 150 shares. It's $1. So if but if I am buying, you know, trading low float penny stocks or whatever, for example, and I buy 1,000 shares, if I go on ARCA or if I go on Nasdaq, and I believe the Edge too, but I know not ARCA and Nasdaq, and I sit on it's called adding liquidity, and I will get they'll pay me to add liquidity, because the stock market functions like it does because of liquidity. You know, there's people with shares at this price, whether they're market makers or they're other traders, we don't know, but because of people being at different prices with shares, it lets the market function like it does. And so they reward you for providing liquidity. Now, if I just jump in on I didn't have to click that, but if I just jump in on the ask and buy, I took liquidity, because there's shares on the ask right here. There's 70, okay, so how these numbers work, there's 7,200 shares at this price that I can buy. And when all these shares get filled, when all these shares get bought up, it goes to this price. When all these get bought up, it goes to that, you know, and so forth. So this disappears, it slides up, and this thing just moves around like crazy fast. But the thing is, you can't take it as seriously as that. Like you, the problem is, like this, for example, I can do 10,000 shares and then hidden, or I just want to display one share. So literally 12. So if I want to buy 10,000 shares, let's say I have, if I was right here, you wouldn't see this number still says 69, but I have 10,000 shares. So that number wouldn't be 69. With 10,000 shares, it'd be a lot higher. So, yeah, it'd be a lot higher. So, people can be hiding anywhere in the level 2 with a lot of shares. or they can do something crap, shifty and shady. You're not supposed to do it, but they can act like they have 10,000. They can have 12 and 10,000 here, and give the impression that they have more shares than they do, and they frown upon that. And you'll get a letter from the exchanges, saying what the hell are you doing, or the Wall Street will come after your ass, honestly. But from what I hear, I don't mess around with it. But so so we know that when every penny counts. Like 1,000. Let's say you have 1,000 shares, which I don't recommend anybody uses. Your first year or two, until you can prove that you're consistently profitable, then I don't think anybody should be trading 1,000 shares, because I did, and I thought I had a grip on trading, and I lost a lot of money trading 1,000 shares at a time and 500 shares at a time, because I wanted money. Well, when I quit worrying about money and just working on trading well, then my trading improved and I started making money. But so what happened was, when I first got into trading, I did what I was doing. So I was basically just gambling. But I thought I was good because I was winning money. I'd make like $600 in a trade in like 10 seconds, or $1,200 in 30 seconds, like just buying like kind of randomly. I just thought maybe it's going to go up if I buy it here, And sometimes it would, sometimes it wouldn't. But you can't be consistently profitable like that. You have to have an edge. And so we know we have to have an edge. So you need to know stuff like adding liquidity. You want to do that if you have a direct access broker. You want to add liquidity as much as possible, because those rebates add up. The rebate is, for 1,000 shares, you get $2 rebated. So that comes in handy if you do. If you're at that level where you're trading thousands of shares a day, then that adds up, and it takes away your commissions. Because if you're trading thousands of shares a day, you're gonna have high commissions. It's gonna add up, and you want to be able to offset some of those costs, but some of those fees. But so when you market order, or you buy on the ask, you're getting in right here. Unless you want to sit up here, you want to wait. Let's say we didn't see this, but you're like, okay, when the price action breaks out above this resistance, then, well, let's say you wanted to say, you were like, okay, I'm going to trade a breakout trade. I'm not going to trade until the price is, I'm going to put a limit order at 289.11 or 289.25, and then I'm gonna walk away at whatever. When you'd sit way up on the ask at 289 and 25, so when that came, you get in and you ride that momentum with it up, hopefully. But so there's that way to do it. You can sit on the bid, but the problem with that is you have to wait until other people are selling on the bid. So people sell on the bid when they can't sell on the ask. So usually that's not, in my opinion, that's not a good place to be for most strategies. Now, so for example, like right here in the trading, if you want to get in right here, you need to buy in on the ask. You're not going to get filled in the bid here. If you right here, if you want to get out, because there's strength, like right here, I got out on the ask. So on the ask, you get out on the ask. You sell your shares on the ask by people wanting to get in. So you want to sell in strength near the top because that's when people are like they're buying the top. You want to pass your shares off to someone when the price is strong, because it'll go on the ask and this is like, whoa, people are all around the world are seeing this has been up, but they don't know it's going to drop right here. They think it's going to go higher probably. A lot of people do. So I sold these shares on the ask. I put them on the ask and then they sold because someone was ready to buy them. It happened so quickly. But if I was right here and there weren't enough people that wanted to get in, and I was on the ask, I'd have to cancel my order real quick. I have a hot button, or I would, and then I would have to sell on the bid. And like if a market order, if I just buy, I'm buying on the ask or the asks multiple maybe. There's a slippage, but so, and then I would sell, and it fills me at the bid price or lower, depending if the price is dropping really fast. So what a lot of times I'll do is I got in here on the ask, and then but I also will see this start curling up, like it's showing it's got support, and then I can do a limit order real quick, or like I can start going okay here, and then if it touches this point again, that like I wouldn't have got filled here, but you can do that too. A lot of times it'll base out like here, and you just set a limit order, around here, and like a third candle will come, and you can get filled like that. But trading is so fast that for my style, when I get in, I like to just get in on the ask, unless I'm buying a double bottom or whatever, and then a potential double bottom, and I have a limit order set. When the price gets, here, I'm buying. So, if there was another bottom, it was over here from the day before, or earlier in the day it bounced here, and then the day before it bounced there. So I'm like, okay, if it bounces there again, I want to buy. I have a limit order there. That's one strategy, but so I generally buy on the ask, and then I try to sell on the ask because I'm getting more money out of it. The spread here is only 8 cents, so on 100 shares it's $8, but it's $8. And if I had 250 shares, like I was pretending today for the practicing, then that's $20. So that type of stuff adds up. Now you can get filled in between the bid and ask. That's not something like I ever really focus on. I mean, but there are people that will just put out orders in a mid price. I do that with options. I actually made hot buttons here, sell 25, 50, 100% at the mid price. So to get in here, it's $6. I mean, to sell here, you could sell it for $6. We can buy it for $19. So you sorry, I have this gum. It's like really annoying, but so let's say I got in at $5, and I had 10 of these. That's $50 I paid, and then it's at 19. So, and I want to sell. I can sell at 19, limit order at 19, and I can try to get out on the ask. If there's enough people that are trying to get in right then, my order will get filled. But if not, I can sell at the mid price between 6 and 19. So, and if that order isn't full or whatever, I just cancel it right here, and then this closing out is a market order. It's just, oh crap, I just need to get out now, quick, boom, get out. That's the safest way to get out. Or there's stop losses, but so I'll explain those now actually. So what I like to do is, the cool thing about this broker is I made these custom buttons that if I get in here, right, let's say what I'll do sometimes, I'll get in here, and once the price starts going in my favor, I'll put a stop at entry, so that, and I did this a few times today, but I will, worst comes to worst, I will lose no money, just commissions I paid, which is, a couple bucks, or I'll barely lose any money, because it'll create a market order to close out the position if the price comes back down to where it started. I can also do different stop losses at any price I want. Stop, and I can have it trigger that when it gets to that order, it sells or it buys. So I just go to stop, and then the price, and then whatever I want it to do when it gets to that point, buy or sell. There's stop limits, which are a little different. So, if I want to say that when the price gets, if the price gets to 288.95 or 289.03, so I would go, or 289, let's say 289, and then limit 289.10. So what's going to happen is when this price action gets to 289, it's going to trigger this order. If I said buy, or if I said sell, let's say I wanted to trade the breakout of this price action. If the price gets up there, I want an order that gets me in 400 shares. So I would just do my stop limit, and when it gets to 289, the order is going to trigger. It's going to fill me either at 289 or some number between 289 and 289.10, and then it won't fill me anything higher than that or lower than that. That's the price, and if anything, it just won't fill me if it can't give me those prices. But usually it works. You get filled around 289. So those are really convenient. I'll explain a couple others. So there's limit, market, stop, stop limit. Trailing stop is if I want to trail a price. So let's say the price action's here. I haven't got it. The price action's here, and I'm like, I don't know how much higher it's going to go because I can't tell the future. But I know that there's some resistance up ahead. These are all potential areas of resistance, and some are more significant than others. So these are moving averages, by the way. This is the 8 moving average, the 21, the 34, which is the 8's the momentum. Like when it gets above it, then the momentum's shifted to the upside. When it gets below it, it's shifted to the downside. But this is short term. This is the last 8 minutes, or this is a 5-minute chart. The last 8 5-minute candles, the last 8 days, the average price. So the 21 average, the 34 is for I use for trend direction. So I'll use it as like a stop out. Like if I'm trading to the short side here, I'm gonna stay in this. I'm gonna take profits along the way. Take profit. But if the price action, the candles get close above the white one, which is 34, then to me the at least the near term direction is shifted, and I'm gonna get out of at least most of my position. The purple line is VWAP, volume weighted average price. This is the 89 EMA. This is a 200 SMA. I chose the SMA for the 200 SMA because a lot of traders worldwide use that. So, you want to be trading things that a lot of other people are trading, so that there's volume and you're able to get in and out, and you're not fighting market makers, because you don't want to be like, it's basically you're just battling the robots, I call it, but the algos, they'll bring the price up and they'll eat stop losses. People that are in short here, they're gonna have stop losses just above this to get out, likely. So the market makers know that, so they'll drive the price up there just to eat the stop losses and take that money, get people stopped out, and then they'll come back down. You gotta be mindful of that. Got a achy neck, but I sit in front of this computer way too much. But so you don't want to be battling robots, because they're faster, smarter, better than pretty much any retail trader, and they have a lot more money than most. So their job is to just go through and just take stop losses. So it's really important to strike while the iron's hot and get in and get out. The longer you sit with your money in the market, if you're scalping, the higher the risk of losing money and substantial money, is. So yeah, you have a trailing stop. So if back to my point, so right here, I'm in here, and this candle went up here and it kind of went down. I said, you know what, trailing stop for 20 cents, which is 100 shares is $20, 500 shares $100, whatever. 20 cent, and then sell. I want to sell 20 cents. So let's say I clicked it when it was right at the top here. I said, okay, if it drops 20 cents or whatever number I put, then I want to get out. Well, if the price action went down 20 cents, which it did, so it would have stopped out right up here. It's a trailing stop. You can do ones for buying if you're short. If it goes down here and you say, okay, trailing stop for $1, if the price gets $1, it goes $1 against you, it will close you out of the order. So you preserve your gains. Those are really effective. I don't use those too often, but super smart orders is something with Lightspeed. I don't use it, but it's if you have something that you're not sure which where to get it at, because there's different direct access brokers. So I can go to any of these. I can buy shares at Arca, EdgeX, IEXB, Lightspeed one, I guess. All these different NASDAQ, NYSE. If I don't know if they're all probably gonna have most of the stocks that we want to trade, but some people that don't know, or they don't they trade stuff that's more rare, then they want to make sure they get filled. They would go to that super smart, and it will send out orders to 5 different markets to get them filled. There's these other ones that are more complicated. Limit on open is a little complicated for this video, but it's a limit order at the market open. I don't ever mess with those. Limit on close. It places a limit order when the last second when the market closes. Limit on open and about. Those are just complicated. Market on none of these. There's dark, which is cool. If you have you're trying to you want to buy 10,000 shares of something, or 20, 50,000 shares. You use dark pools, and you get filled. They have a lot of liquidity. So, if there's only 300 shares on the bid right here, but you want to see if there's prices on the bid or in between the bid and the ask, and fractional in between a cent, like 1.38 cents. I mean, some people do trade like that, then you can use the dark, and there's these other ones that are they're more for like um, professional, like investment firms and hedge funds and stuff use that stuff more. But yeah, I stick with limits and markets and trailing stop limit, all that. So yeah, so now you know that. So let's go over this. You have the ask. That's where people are selling. These are the sellers there. But a lot of these are market makers. The market makers move the price. They're the ones that, through computers, they create the spread. Some stocks have bigger spreads than others. This is 1 cent with 100 shares. It's $1, $6 now, and it fluctuates. And when the price is dropping, the spread gets wider. When the price is going up, it gets wider. When it's just kind of just chilling, it gets real small. It'll be, they're different. The more expensive a stock is, the bigger the spread will get in general. But that's not always true. Like SPY usually has a really small spread. Like usually it's like a cent or 3 cents. Like sometimes it's more though. But and then what else was I gonna show you? Yeah, so it helps the market. It's basically a tug of war game, and there's buyers and sellers, and when there's more buyers than sellers, then the price goes up. And there's more people selling, then the price goes down. When short sellers, there's people that, so right here, there were people that shorted here, people that shorted here, people that shorted here. There were people that closed out their longs here. There are people that went long here, went long here. There's people that do all over, but you get these big price moves when, like, okay, somebody, traders somewhere saw this level as resistance, and somebody said, I'm going short here with, 500 shares, 3,000 shares, whatever. And so they started booming, the price goes down, goes down, goes down. And then it gets to a point, and people took profits along the way, some of them, but, the best traders and the heavy hitters are going to get it down to here, and they're going to take some profits. And so when they take profits, when you get out of a short, you buy. So they buy because when you sell it first, the broker credits you, and then when you want to get out, you buy, and then you make the difference. So shorting can be very lucrative because price action to the downside takes the window or the elevator, and bullish price action usually takes the stairs. So right here, shorts covered. They bought, and then they started shorting again, and some people went long here too, and some people tried to go long here, but less people. More people tried to go long here, or than right here. But this is a lot of shorts covering, and then price went down. Once it starts going down, shorts come in, more it goes down, and then it starts going up because they're covering, and then all of a sudden it starts coming out, and more people are like, crap, I'm gonna get out that were short, and they get out and it pushes the price up. And then when there's people are done getting out, and then the people on the long side are outnumbered by the people to the short side, it goes down. So, or the amount of shares and volume to the short side, and it goes down. And sometimes there's not enough volume that there's the volume's low, so the market makers are controlling the stock, and they're driving it up and they're driving it down. That's why the first couple hours of the trading day and the last hour are the most ideal times uh, for most strategies, because there's more volatility. So the retail traders have more of a say in the market. The robots kind of gotta work with us in a sense. So that's yeah. So whenever you that really helped me when I was trading. To understand that there's buyers and sellers, so you look to identify how you learn to identify when a short squeeze is happening. That's when the price is just going extremely bullish. Um, they're like, this is panic right here. Like, people, they're going selling, selling, selling. Let's say there were longs right here. Okay, it's going up. It's a new day, so it started going up. Like, oh, I'm getting long, I'm getting long. Usually at the top, usually there's the most volume. There's the most volume in the second candle here for green volume, but um, a lot of times right here will be high green volume, and then people are like right here going, yeah, go long because it's gonna break out. It just broke out, and then boom, they get rug pull, and price drops below the 8 moving average, and then it keeps dropping, drops below the 34. Now we're trending down again. This is a new day, so we didn't know if we were gonna be going back up, or I mean, considering we had a 2 day or a 1 day pullback, we were due for another extension. So it's actually going to be nice, because how I look at it is, the further the rubber bands pull, the faster the snap's going to be. So that's the analogy I used. When I think about what the market may do. So, but yeah, so they went long, and then they rug up pulled, and then they're panicking. They're going, and then so they're like, crap, like it's not going. Okay, it's going lower than crap. I'm losing money now. Okay, is it gonna bounce? Like, okay, crap, it didn't bounce off any of these supports right here, and then they're getting out, like, sell. I can't take the pain anymore. Sell. It's emotion. People are like, ooh, cool. It's price is going up. And they get in, and then, oh crap, it's not. And then some people panic, sell, and shorts come in and sell, and then people panic, and it gets these long, droopy candles. And then the shorts cover it, and then pile on again, cover, long. It's not gonna happen. Shorts pile in, people panic, sell, until that happens. So we're trading against human emotions, and we have algorithms and hedge funds and billionaires that can lose billions of dollars in a day, and it doesn't faze them. So that's one of the reasons why the stock market's the hardest thing that anybody could ever do, in my opinion, and a lot of people's opinion. Statistically, 90 to 90% of traders fail. So I told myself, I'm not going to be one of the 90 to 99%. I'm not going to do it. I'm going to do everything in my power. I'm going to study harder than anybody else, which is, obviously not true. I mean, there's always somebody that's going to do better than you. But the mindset I had was, I'm not going to half-asses. I'm in front of the computer studying charts, going over the trading day, going over charts, price action, educational content every day, all day, 12 to 16 hours a day. And then, a big thing for me was when I sized down, because I, excuse me, I lost, I got into the stock market, and I made like 6 or 7 grand in a couple months, just blindly throwing money at stocks, and then it would go up, and we were in a bullish market, and I thought I was, pretty good at this. And then I thought, wow, if I start learning about it, then I'll, I'll be that much better. And I'll only, if I'm making this much money now, like $200 to $600 a day, then I'll only make more when I learn stuff. Well, the more I learned, the worse I did. I got into like a 3 or 4 month red days every day, like 100, 200, $400 a day every day, and then like I kept trying all these different things, kept changing my strategy, and my strategy changed so much that I didn't even know what style I had anymore. And then all of a sudden, in 1 week, I had a couple like aha moments, and like light bulbs went off, and what it was for me is I said okay, and then right when that happened, things started clicking. Some of the things that I've explained in this video, and some others, but I'll get to those in another video when I touch upon that subject more. But yeah, so I that happened, and then I developed an edge, and my first edge, which is trading off of UVXY. UVXY trades inverse to SPY in general. So, and SPY and UVXY are like the wind. And so, if I get in a trade here, and I know that the wind is right about here, the wind is telling a story. Let's look at the time. It's 12:30, so 9:30 on this time, because it's that's East Coast. Let's QQQ. No, that doesn't matter for this. Excuse me, but this would it's just a regular ticker. Anyways, my point in that is my edge is using UVXY as the wind and SPY, and I map out patterns in UVXY and SPY. So I have these two, this window in another monitor, on another monitor, but it's where I can see it, and all the time I'm constantly going through here, marking areas of consolidation, because when there's consolidation, it's like a pressure cooker, and all this pressure builds up, and then it breaks out. Usually, like something like this would break out more dramatically, but it is Friday, so we can get, like, here is a head and shoulders. Head, shoulder, shoulder. This is a bearish pattern in general, but they don't always work out in the way that they're supposed to. But so this right here, I didn't see this till now, but I was actually this time I was trading my other edge, which is a counter trend strategy, which I'll explain in another video. But so if there's multiple ways you can do this, but a lot of people they see this other shoulder start forming, and they enter the trade, or you enter at the break of the neckline, and then you have a stop just above the neckline, and then there's a trade there. Boom, you caught. This is UVXY breaking down. So whatever ticker I'm on would I would trade to the upside. So you give it a little bit of time, practice, and get the hang of it, and you'll understand. This is breaking to the upside, and as you're marking this up, you're waiting for the neckline to break. You're on your ticker, and you're marking. You're like honing in on what is it doing. Like you're just whatever the stock's doing, you're marking it out, and you got your eyes on, I do, on UVXY, SPY, marking it out, and when I corner them all three, and they're all on the same page, and they're breaking out of consolidation, or or these guys are bouncing off a double bottom or double top, or whatever, then I can strike, and then I have a higher chance of success. Uh, that's the strategy that really saved my trading. That and sizing down. I had to size down to a share size amount that didn't affect me emotionally if it went against me too much. Like before, I was just like 1,000 shares this and 2,000 shares and 500 shares and just trying to make money. But I quit worrying about money, like I said earlier, and um, so I got 1 share of Amazon to start, or 1 share of Tesla, or 25 shares of Apple, and quickly I started realizing, like, dang, I can make a couple $100 just trading 25 shares of Apple. This is before the stock split, so I'm talking 25 shares of like a $400 or $500 stock. And it could be done with $100 stock if you did it right and or got lucky. But that's a little less realistic. But so yeah, I quit worrying about the money, and and these light bulbs went off. I started realizing, if you trading is one of those things that it's one of those 10,000 hour you know uh, activities that you need 10,000 hours in general to be good at, really good at. And I don't have 10,000 hours, but I'm well on my way to it, and my trading has improved a lot. My I'm still not sized up a lot. Like, I mean, today I was super low sized uh, because it was Friday, and a 3 day weekend. Not just because it was Friday, because it's a 3 day weekend. Um, that makes it so much harder, in my opinion, because people aren't trying to leave risk on, and go long stuff, or keep their money in the market for the holiday. A lot of people aren't willing to do that, so there's less liquidity today, and volume wasn't there, and then it was just Fridays also are harder to trade, in my opinion, in general. But so I just took it easy today. I wasn't willing to lose $200 or $300 today, and it's a good thing. I mean, I only made $41, with so it's like a joke. But like I said, I only made 15 of that because of commissions. But it wasn't about the money. Even on the big days, it's not about the money. I'm averaging between like 150 and $300 a day, and if I lose money, it's not much at all. Because I'm doing low shares. Like, if I get you for a while now, it's been like break even's been the lowest. Uh, and that's just because I size down. I can hang because if I try to, I've gotten like 100 shares of a $500 stock recently, and I can hang, but I can't hang like I can in other trades, with less shares, and I can let the trade, do the work. I just set it up, get it in a good position where it has, a chance to break out and run a long ways, and do that. But the counter trend strategy I'm speaking of is the one I like to trade the first hour or two of the day, and then I look for patterns off UVXY and SPY and whatever ticker I'm on. But the counter trend strategies basically finding stocks, and I have a scanner by a company called Intensity Stock Watch, and I highly recommend giving them a shout out, or giving them a try. It's really good. It's one of those. I'm gonna do a review on their scanner, but it's good for it's good for the counter trend strategy. So when the price gets extended too high away from the 8 moving average, and the price is at a significant daily, or you know sometimes 5 minute, whatever, it has to be a support or resistance that has like a high probability of you know, restricting the stock. And so it's what I do is like I like to short a lot of pops, like that hit somewhere on the daily. Like if the price action was here, and this is daily, and we're on today, and the price action on the 1 minute is all the way to right here, I'm gonna start shorting if it's extended off the EMA, like that far off, about. And so I short, let's say 100 shares short, and then if the price action goes higher, depending on how the price action's going, I'm gonna do short. So I start with 100 shares, and then I'll do another 100. So my price, my average has gone up, which is good for shorting because, um, when the price drops down and I sell, I want to sell for the lowest price. So, um, then so I do 100, 100, and then if I have to do another one, I I I gotta see weakness, and it has to be really extended. It can seeing weakness can be seeing too much bullishness, because I know it's about to give up. Can't just keep going like that. It's too extended. So I'll do 200 shares. Let's do 112, and that brings my average up even more. And then the price, when it drops down, like I said, it takes the window or the elevator. So it usually it's quick. You take 50% or 75% of your profits, hopefully under all your entries. But sometimes it's important just to take some off the table. 25% or 50%, just to make sure that you're green somewhat on the trade, and then let the rest ride. That's how I approach that. And the scanner's really great. The intensity scanner, it shows when stocks are real extended to the downside. There's a lot of it's intensity. Like there's a lot of it's real extended, and people are emotions are high, and so the higher the intensity reading, the more likely the stock is to reverse. But you can't just go off the intensity reading and just throw money blindly into the wind. Like you'll never see it again. You have to understand daily support and resistance levels, and you gotta understand that by studying chart price action and charts, and it takes time. I have a little over a year right now, and over the last few months, it's really clicked. I had months of red days, and it was painful, and had depression, and I felt discouraged all the time, and finally I was able to get out of that rut I was in, and it was awesome getting out. So I'm really happy that happened, and it happened because of hard work and determination, and another scanner company, Black Box Stocks, is where I learned a lot of my trading skills from. I learned the counter trade from intensity, and from online some other traders I watch, and then I learned the pattern breakouts, trading off UVXY and SPY from Black Box Stocks, and I still use Black Box Stocks, and I still use intensity, because I do both strategies, and they're both just great companies, in my opinion. If you'd like to know more about any of those people, I'm not affiliates or anything yet. Like someday maybe, but I can point you in the right direction though. Yeah, so I think I'm gonna end it there. But thank you for listening to this video. I hope it was educational. I hope it helped as many people as possible, because these are some of the questions that I had when I was a few months into trading, and I didn't get a clear answer to. So hopefully I explained and covered everything that I wanted to. If not, I'll make another video and cover what I missed. So thank you. I hope you have a nice day. I hope your trading goes well, And please, if you're not consistently profitable yet, and you're doing 100 or hundreds of shares, please consider sizing down, because it did change my trading and ultimately changed my life.